Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for March 15th of 2026. Well, as we come closer to the end of the first calendar quarter of 2026, really good time to take a quick check-in on where things are with regard to economic growth estimates in light of the Iran conflict, and we've got a lot of things to talk about in that regard today in the chart pack. But just going back in history, so this is the Atlanta Fed. You've heard me talk about this quite a bit. They do a very reasonable job of predicting economic growth based on the observable data at the time. And you can see going back in history here, if you look back several quarters, this is the second quarter of 2025. We started off with kind of a benign 2% estimate, and we wound up through fits and starts, and again, economic data as it was released, they made changes, and we wound up getting a better than expected number in that quarter. And third quarter was really building optimism throughout the entire period. We got to the fourth quarter, and it started off, a little bit higher, lower than the third quarter, but it really rocketed higher. And so, as we got into the very first part of the year, there were some really strong estimates out there, and what we wound up with was something that wasn't materially higher than the original estimate. But here, as we look at the first quarter 2026, we've got the Iran conflict, which dropped that a little bit based on some of the data. And again, a lot of this data is really lagging, so I wouldn't put as much stock in this being affected by the Iran conflict, perhaps. But where we are now in this estimate is about 2.8, and you can see down here the kind of the derivation of all of this. We've got basically net exports, which are a little bit higher. We've got a chart on that. A lot of that has to do with gold. We also have an increase in imports, which is an offset to that. And then when you get down into some of the other components, it's really kind of a muted circumstance here. Now, the current contribution, this is for first quarter, maybe looking net a little bit higher. We've got a little bit of residential investment, which looks like it's adding to the calculus here, but overall, just kind of data dependent, and so far looking at around 2.7, 2.8% for the quarter. Now we need to talk about the impact of the Iran conflict. And we've got a lot of data to show you on estimates related to that. This one in particular is a representation of what could happen to inflation and on spending. And generally speaking, if you have basically a geopolitically influenced energy shock and it's short-lived, the impact is really not going to be that great. This is personal consumption expenditures, and again, we're talking about basis points here. So a 1 basis point is basically 1/100th of a percent. So not a lot of impact here, even when you look at 12 months versus 6 months. It's really not that big of a deal if it's a 10% shock and it's relatively short-lived. Now, according to Morgan Stanley here, a persistent shock, which I would agree with, if it were to happen, it would have a more meaningful impact on the same level of consumption here, and particularly in goods, durables and non-durables, where durables are really, only modestly impacted here in the short run. So, obviously the big question as we, linger into the final days of the first calendar quarter of 2026 is, really how long is this going to be? But, again, I would probably go to what I said in the last slide, and that's that, if this thing lingers and there's more economic shock to the United States, then, being an election year, people are going to take notice, and I think that will be relevant here in the coming weeks. Well, as you might imagine, here, anytime you talk about an oil shock, generally the reaction is a little bit more pronounced than the actual effect tends to be, as we just discussed in that last slide. But not too surprisingly, we had a a spike in, at least in the prediction markets, as far as the probability of recession, now sitting at 30%, and that had been sitting quite low. And even, most of the investment banks were around 20% or so. So again, not terribly surprising, but again, I'd just like to reiterate that these sentiment indicators tend to be a lot more aggressive than what actually turns out to be the case. We got headline inflation, which really was pretty much in line, all things considered. So you got the headline inflation number year over year, 2.4. The monthly number was 0.3%. That was in line. Core inflation also pretty much in line. You could see core inflation. Again, this is something that, if you're talking about inflation expectations, perhaps they've moved up a little bit. Not only do we have tariffs, but we're going to have energy prices that have moved up, and the sentiment is generally going to suggest that we're going to have a rise in inflation. This is core inflation, which excludes energy and food. Headline inflation's been a little sticky here, but 2.4 is a lot closer to the Fed's 2% target. We've got 2.5 on the core. Again, not too far off. Absent tariffs, absent geopolitical conflict, I think we'd be well on our way to getting to that eventual target. We look at the contributions to that inflation. You can see basically, obviously the core inflation, which was 2.5, as we just said, and then headline inflation. You got goods and services, and services are represented by this kind of like pinkish purplish line here, and you can see a very notable downtrend in services, and we've got a chart on services, and that's been really the bell cow on all of this inflation reduction has been the service side. Energy we've talked about, and food we've talked about too. Here is that services inflation. You can see a notable downtrend here amidst the kind of the noisy and somewhat seasonal data that we get on a quarterly basis and monthly basis. But again, this is in a long-term downtrend. Another thing that I thought was really notable in the latest release is that we're getting some rent deceleration as well, and that's very positive from housing affordability, even if, as we'll see here in a couple of charts, that we've got mortgage rates that are moving a little bit higher because interest rates are moving higher across the spectrum. But a positive takeaway, at least on rent. Here we have estimates that have now been changed, and I alluded to this a few slides ago, that in light of everything going on, this was just take the headline PCE number. This is the original forecast that Goldman Sachs had. Now they have given us some scenarios, so basically their new forecast is going to be in this line here, and so essentially they're looking for about a percentage point of increased inflation on an annualized basis as we get into the second quarter, and then that decelerates as the effects of this diminish over time. And on the core, even here's their baseline forecast, and then here's the revised forecast. So even stripping out energy prices and food prices, they're expecting some additional inflation to come out. And again, this is not what the market wants. In fact, as we see here, that the implied number of rate cuts has basically gone to zero, where it was like over 2 cuts this year of 25 basis points or 0.25% expected during 2026. We've basically taken all of that out because the fear is that we're going to get additional inflation, and obviously you wouldn't want to be cutting rates in the face of that. So now we need to talk about the inflation trends here. And this goes back just as we saw in the economic growth chart, but this happens to be looking at expected CPI year-over-year inflation at the end of each particular year. So as we started estimating 2025 in the beginning of that year, looking for low inflation, that spiked, but then those inflation expectations, as more data was realized, eventually came into something close to where a lot closer to where we are now actually. Now the 2026 estimates started off high and then went lower, and then of course the energy price spike here has led those inflation estimates to move higher. Again, really consistent with what we saw in that Goldman Sachs estimate in the prior slide. So not only do we have the impact of the Iran conflict, but we also have the impact of tariffs. And what we see here in this chart is you've got items that are more exposed to tariffs. This is the core goods prices in those categories, and you can see that they're stretched above those categories that are less exposed. Although it's notable here that the less exposed categories are even going up as well. And one example of that is apparel. We can see, heading into the first few months of 2026, that apparel is moving higher, along with several other items that have some tariff exposure tied to them. Here we have customs duties, so this is kind of an indication of the tariffs. We did have a downtick after the IEEPA, excuse me, tariffs were deemed unconstitutional by the Supreme Court. So those tariffs have gone down, but you can see very clearly that the level of tariff duties that are being paid is much higher than it was a very short time ago. But having said all of that, we go to the Business Roundtable CEO survey, and this is their first quarter survey, basically. And again, it shows you the time series of their sentiment over time. Again, if you look at the overall outlook, which is in the black, is moving higher, capital spending higher, employment, here's sales, but here's employment, but all of those indicators moving higher. Now, I will grant you that this survey is a little dated in the sense that it is not going to incorporate any issues related to the Iran conflict, at least not yet. So, we'll have to see if this reverses course, but at least as we headed into the month, the CEO confidence and CEO sentiment was actually pretty good. Petroleum reserves, we've talked about this. This is actually a little bit more of a current chart that I have, because we were in the process of kind of rebuilding some of those reserves, but really not back up to where they were, the 700 million barrels. But I was very curious to see what the impact of releasing those reserves was. And my theory and my recollection was that it did not have a very big impact. Now, in some cases, when we go back to 2005 and we look at several instances where we did release from the SPR, it did help, but then other instances, it really didn't help as much. And so the impact at best is maybe modest, but it's not something that I would hang my hat on to say, hey, if we're going to release another 100 million barrels, that's really going to have a material impact. It's really going to be tied to what happens in the Strait of Hormuz here in coming weeks. And speaking of Hormuz, here we have traffic, which we showed you last week is basically to a nil. We did have a Chinese vessel that made it in. We have some Iranian vessels, which oddly enough, if you control by threat, passage through by foreign vessels, those vessels are going to reroute and do something different, but your Iranian vessels are going to move through. So this little slight bump here represents Iranian vessels, but essentially it's closed. And as a result here, we see, very large crude carriers, the VLCCs, moving through the Arab Gulf to China. These spot rates have gone nuts. And again, this is just to China, but the issue here is going to be how these prices get passed through to the end consumers. And again, this is just one, microscopic, piece of evidence here that the costs of the strait being closed are actually very real. So as a result, we've seen Brent crude futures that have kind of jockeyed around 100 and then went back down closer to 80, and now they're over 100 as of basically Friday. And then you've got the estimated hit here to Persian Gulf oil exports, and you can see that Hormuz is still very, very important. We've got some ability to redirect some modest volumes through other canals and other waterways. Again, it doesn't move the needle that much. Right now, on at least a 4-day moving average, the displacement's about 16 million barrels a day, but that could be as high as 20 million barrels a day. And as we saw last week, outside of the Strait of Malacca, I mean, this is the second largest passageway for crude heading around the globe. So the supply shock that's caused by this, basically the shutting down or the closure of the Strait of Hormuz is really it's with very little precedent. I mean, you've got price changes here during the Iraqi invasion of Kuwait that were very real, and we had a mild recession partially as a result of that. But the actual displacement to supply was, not overly significant. This is the percent of global supply here. But what we've seen, as I just showed you, is and this is actually a little bit dated. As I mentioned, it's closer to 16, 17% here. So again, this represents a pretty meaningful deal. Again, not very much impact net on the global economy if it's relatively short-lived. Now, having said that, if it does linger, and again, and these estimates here from Bloomberg Economics, if it's closed for a month, if it's closed for 2 or 3 months, you can see the impact does get pretty meaningful, and you get oil prices in the case of having Hormuz close and 20% of all oil volumes be basically shut off for 3 months. They could say crude prices could be upwards of $160 a barrel. Again, I think that that is just impractical from the standpoint of what it does to economies in that event. And again, the most notable of which is the U.S. economy, which is far more insulated to these things because we have a more diverse economy, and the fact that we're a net exporter of crude these days due to shale. But these are certainly global impacts, and it could change the calculus a little bit. Again, I think that we're looking at something that's probably inside of this, and because I think the impacts of realizing these are so draconian that world leaders, especially President Trump, he can't stomach that. This is some data from the Fed as reported by Apollo. So this is the Fed's model. Again, if you have peak impacts on inflation about 0.7%, core inflation here you've got a 0.1% unemployment, and real GDP again peak effect very, very modest. Again, this is as I mentioned before, U.S. is a net oil exporter. Energy efficiency is stronger. We don't use as much oil per unit of GDP than we used to do. But again, this is assuming that we get to $100 oil, and even if it persists for a little while, again the estimates are not that draconian. Probably nearly as draconian as the Bloomberg model would suggest in that prior deal. Because if we get $160 a barrel, that will very noticeably change these numbers, I think. But again, I think these numbers are realistic to work from for the time being, especially if we feel like this is going to be kind of a shorter-lived event. So again, this would be more of an issue if we're heading into the peak usage season, but we've got home heating oil moving higher. Again, we're heading into the summer months, so this is not going to be as big of a deal. This might be a bigger deal. We've got jet fuel costs that are moving higher, and so you're going to see that in prices. Most of the airlines do not hedge jet fuel costs, and so I think this is already manifesting into meaningful fare increases, especially on the long haul flights, the ones that say like from Sydney to New York or Sydney to London. Those flights have essentially become 25, 35% more expensive. Here we have urea futures, not a statistic that we often cite here, but it's a very important component into fertilizers. And you think, fertilizers are used to grow crops. And if your input costs into the crop growing mechanism go up and by an appreciable amount, and I would categorize this as an appreciable amount, then you are probably going to see that show up in food prices. And this may be one of those things that kind of lingers around. One of the things that keeps inflation higher at the headline number is because it'll take a little bit of time to pass all this through to end prices for goods that you find at the grocery store. And then, not to be left out, we've got the industrial metals. We've got aluminum at a 3-month really the 3-month here is as high as we've seen it since 2022 basically. We have yields that are moving higher. We've got the 2-year yield that is actually up over its 200-day moving average, which is technically important. We've had a pretty big move here in the 2-year Treasury, and you can see, and we've also had a move of roughly 20 basis points or so in the 10-year. But as we see the curve, which had consistently steepened from July of 2024 through recent memory, we've seen a little bit of flattening, but we're still positive between the 2 and the 10-year by about 0.5%, about a half a percentage point in overall yields. And naturally, if you see an increase in the 10-year yields to any magnitude, you're likely to see a corresponding increase in mortgage rates, which, as we see here, have been coming down for a period of time and recently moving just a little bit higher. Again, the effective rate on mortgages as people sell and then buy new homes with a new mortgage, and you're replacing old mortgages with new mortgages at current rates, that number continues to climb over 4%. But this is at a time where housing affordability remains quite challenged. This is not a welcome sight. And so, again, if you have more expectation of inflation, this is the way to look at it. If you expect more inflation and you expect that inflation to be systemic, and generally speaking, on these oil shocks, people tend to overreact and overestimate. And so your long-term rates move higher, mortgage rates move higher. The whole plank for the Republican Party heading into this fall, and they're really trying to hijack it from the Democrats, is affordability. And so, you can't have 7% mortgage rates and say that you're addressing affordability if those interest rate increases are born out of inflation fears coming from geopolitical conflict. Quick check on consumer spending. The K-shaped economy is alive and well, as shown here by this chart from Apollo. We've got low income earners that have witnessed an increase in spending, but they're still well below their other cohort peers. Here we've got the middle income folks, basically $40,000 to $125,000 of annual income, and then the high income earners, you can see, really just kind of continue to plod along here and drive the economy. So, and this is indexed back to January of 2020. So you can see how that's evolved over time, and you see that these gaps have gotten larger as we've gone over the last couple of years. Here we have credit card spending. Interestingly enough, some pretty strong data here. We've got card spending. We look at this is the last year's data, and then here's the most recent year. Or excuse me, this is 2024 into 25. This is 25 into 26, and you can see that blue line rather consistently, with some exceptions, but otherwise rather consistently above that year prior trend. So consumer spending remains pretty strong. Housing starts, we did see a uptick, and we have in multifamily here. We've seen a downtick in building permits, and that is also tied to multifamily, just as we've seen some kind of overbuilding in multifamily over the last couple of years. We're starting to see some meaningful declines in building permits for the same property type. But overall housing starts, if you look at single family, just kind of flattish, and building permits are negative, and I'd say they'd be probably a little bit closer to flat, but perhaps still negative if you just talked about single family. Balance of trade, very interesting here. I mean, we actually had a narrowing of our trade deficit in the last month. We had a surge in exports, but the irony there is a lot of it was actually gold. Not something that I would necessarily be overly optimistic about. Here we have the dollar. We've got the dollar moving higher, and that's after a period of some decline. Again, this is not a long time series, so going back to November, but obviously February was kind of a turning point in this. But then we've seen some resets here in our exchange rates, whether this one just happens to be the euro to dollar exchange ratio, and so that's moved a little bit against the U.S. dollar. Talk about the stock market here. We have seen more volatility, of course. I just put this one up here as kind of indicative of what the broader market's doing. This is the equal weight index. So this represents, I think, in a better way, what the broader index is doing. And now we're down below our 100-day moving average. So, we've had, this has been a meaningful period of reset for us in the wake of this war. Now, consumer discretionary is very interesting. And again, this is on the backdrop of higher retail sales that we just looked at. But consumer discretionary is down actually 11.5% here in this drawdown. So it's actually in correction territory. So consumer discretionary is in correction territory right now. Here's two charts that I have shown you on a pretty regular basis, kind of keeping you up to date. Institutional managers more bearish after a long period of bullishness, and you can see how relatively quickly that sentiment changed. And as with institutional investors, the individual investors have also become quite bearish in a relatively short period of time. As you see, the whipsaw on these two numbers, and you can see the net bearishness factor is really taking root after a period of fairly strong bullishness here. This is something that I have talked about a lot over really the last several years. That this is not your father's S&P 500 anymore, and then we've got we've got the 10 biggest companies that make up 40%, almost 40% of the index. And again, if we wind up adding OpenAI, and we add SpaceX, and we add XAI, then this number is going to look a lot closer to 50%. And so, and I agree with Apollo's thesis on this. 110% is that the S&P is just frankly not a good diversifier anymore. And you look at the Dow, or maybe you look at a basket of additional indices. But if you're talking about 40% already, and the other 490 stocks fit into that sleeve, and if you add these very notable high technology companies, and you've got basically, I would call it 40% of the index just in your top technology firms, but then you've got 50% overall in your top 10. So again, not a diversifier that we were used to seeing in years and decades past. Margin debt is sometimes a signal for froth in the market, and it's kind of almost a contrarian indicator. In the past, although not perfectly correlated with valuations and with the risk of having increased volatile moments of resets and corrections and things like that. You go back to 2000, margin debt moved up, and then we had a recession. You go to '07, the same deal, margin debt moved up, and we had a recession. Pandemic is a little bit different here, but again, you see the line of best fit kind of fits like this, and you can see how we've really punched through that. Move index is the measure of volatility for fixed income. So as we talk about equity volatility, certainly don't want to lose sight of the fact that fixed income volatility, which as we saw in 2022, can move pretty high as well. And in bond markets, I think run the risk because of the interest rate issue that is predicated on inflation expectations and again the overreactions potentially to oil shocks and things like that. That 2026 could be a year, another one of those years where fixed income volatility may be very close to, if not more than equity volatility. I want to spend some time on an educational topic that I think is really near and dear to our hearts as financial planners, as we help clients work through long-term objectives and near and long-term constraints to help build for better retirements. And so we are blessed with a lot of data on things, and not the least of which are the aging population, what balances look like now, and basically, what the trends are in terms of what people are wanting to do in their retirement lives. And so here we have a list of 10 things that have been compiled by Apollo that serve as kind of like the bedrock of the current thinking here with regard to retirement savings. And obviously, we know that the U.S. population is aging, so check. We know that the population over 65 years is increasing. We're going from 18 to 23%, and we have a lot of retirees that are receiving Social Security benefits, and that they tend to get more from that Social Security than they do from any kind of a pension. And obviously, we know that not everybody has a pension, and we also know that pensions are going away in favor of 401k accounts. And we've seen an explosion in that since they were brought to us in the late 1970s. We have a lot of money in retirement assets, even though I would make a strong argument that there are a lot of people that do not have retirement accounts. And these are old and young people. And surprisingly, we have a lot of younger generations, folks in younger generations that do not have retirement savings and do not have a retirement savings vehicle, even though those vehicles might be available to them at their job. And so, we have a lot of equities. And I might push back on this particular argument a little bit, that if you have a longer term horizon, you can accept more volatility, and having more equities is not that bad. But if you look at the grand scheme and look at all of the assets across the spectrum here, you're going to find that there are a lot of even older workers that are overexposed to equities in their accounts. And again, just to reiterate, this is not a U.S. problem. This is a global problem. I think we've talked a lot about aging populations in China, in Japan, in Italy, even Germany. And so this is not a U.S. phenomenon. And so I think you look at these 10 things It presents a real challenge, but also an opportunity for financial planners like us to really dig into the statistics and make good recommendations for people well in advance of their anticipated retirement date. So we've got more retirees in all of these different countries. You've got, population of the population over 65 moving from 25 to 2050. You can see it's higher in every instance. U.S. is right here. We got 18 to 23%. You can see in some areas, that's much higher, which areas that we've known have aging populations like Japan, Italy, even Germany, France are in that bucket as well. China for sure. Projected life expectancy is moving a little bit higher. And if you look, this is basically at 65. If you're 65, what's the average length of the rest of your life? And it's about 25 years if you live in the United States. So again, that's a relatively long period of time. Life expectancy is just going to put more pressure on advanced planning. We've also had a significant increase in the amount of defined contribution plans, certainly 401ks from their advent, basically in the late 1970s. You can see how that has really displaced a defined benefit or the traditional pension plans, although it hadn't gone to zero, but we've just seen an explosion in 401k plans. Here we have retirement assets. We've got 48 trillion in retirement assets. You can see it's broken down here. We've got a lot of money in individual retirement accounts, IRAs. You've got defined contribution plans, as we've kind of talked about, have really kind of exploded over the years. But you also have state and local government and nonprofits, whether they're the 457 or the 403B type plans. Which 457s are the federal plans, but you can just see that we've had a material growth in the amount of retirement assets, and we need to make sure that those assets are going to sustain those generations as they do age. Total 401k assets, about $10 trillion. See a lot of that in mutual funds. So we talked about this earlier. We've seen it in a couple slides, but this just kind of shows you the track of really how methodically linear this growth is as we've aged. And again, our birth replacement rates maybe around 2.1, but we really need something like 2.2, 2.3 to grow our population. And certainly grow our younger cohort. So as a result, the aging population continues to increase. Here we have sources of income. As I mentioned, more retirees get money from Social Security, which we know is going to be challenged in the decades ahead. We've got pension income for some, but not all. And then interest dividends and rental income. So we have more folks these days that own real property that generates economic rent. And then, of course, you've got people that are just simply working longer, and so they have wages. They earn wages from that. And then cash transfers from various sources, whether it be from relatives or children or whatnot, accounts for a little bit extra there as well. Average asset allocation. We've got a lot of people in the target date funds. These are age-based funds that tend to get more conservative the older you get. Other outside of that, and these are kind of like internally diversified portfolios. Some are better than others, we'll say. But outside of that, if you exclude this as a whole category, you can see how the overwhelming majority of the rest is in equities, and you can almost argue people, might be some people that are getting closer to retirement are overexposed in equities, which means that they're overexposed to volatility, potentially. Here we have retirement as a very common goal. This is what people want. This is what when they're surveyed, essentially 2/3 to 75% say yes, I want to save for retirement. And you've got these other altruistic goals here too. I mean, paying off debt. You actually have a lot of people that are just literally looking, to get to the next check in the mail. But then you also have people that want to save for lifestyle occurrences and those experiences. As I mentioned, fewer people are holding retirement assets despite the fact that we have trillions and tens of trillions of dollars in retirement programs. But and very interesting here that, this is the generation right now that in 15 years is going to need a lot of care. Then these people are generally going to be dying off. These people are going to be, needing probably long-term care. If they're living that long, and average life expectancy after 65 here in the U.S. is about 24, 25 years. So that puts them around 80. And so the younger people here are gonna they're gonna need care. And but you've got basically half, and not quite half on this area here. Basically we'll call them the Gen Xers here, if you will. But you have a reasonable portion of these two generations that don't hold retirement assets. So it's going to put more pressure on public programs and so on and so forth. But even when you get down to the younger generation, these you've got the millennials that are kind of crossing over this bucket here a little bit. That a lot of them just don't have retirement assets, and this is the real opportunity for financial planners to make a difference in their lives 20, 30 years down the road. And I think one of the last few slides I'll show here is a list of listing by generation of those who actually want help. And I think for us planners, this is a real opportunity for us to find ways to engage with these different generations to help them, because it's clear here in this survey that from JP Morgan that they actually want it. Well, finally, we'll close up with a couple of, what I think are just interesting charts here. We've got this one, like the number of objects launched into space. And if you go back, literally like 4 or 5 years, and SpaceX has launched a lot of satellites for basically the satellite-based internet technology, Starlink. And you've seen a lot of launches here in the U.S., but you've also seen a lot of launches overseas as well. And finally, looking at this over the long haul, I just love Visual Capitalist. Their graphics for the visually enhanced people are just tremendous. If you put $100 in 1965 in stocks, you'd have 43,000 right now. This is the Warren Buffett theory. And this is why, for all of those folks, that are clients, that we go through our right capital estimates and you look at the ending balances and you say, wow, that seems like a lot of money. Well, it's a function of compounded growth. And if you are diligent in the plan, and you don't deviate, and you don't react emotionally to changes in the environment, like now when we have a oil kind of shock of sorts, that it can translate into meaningful wealth over time. Again, this is an extremely long period of time and exceeds most people's time horizon. But having said that, even gold, 12,000. Ironically, gold has produced a better return than corporate bonds. And then this is just basically here to reiterate that those of you who think, well, I can generate little microcosmic cash returns, but at least it's kind of safe under a mattress. Well, you're really losing out, because if you do not diversify into some of these other areas, you're giving up a tremendous amount of return. That's all we have for this week. Have a great week, and we'll talk to you again soon.